Wow, Berkshire Hathaway experiences a $25.4 billion loss in the fourth quarter. What happened? This is Dee, and welcome to the Money Growth Academy, where we demystify the stock market, simplify investing, and multiply your opportunities for financial success. What are you talking about? A $25 billion loss. That's huge. Well, let's get into it a little bit. Let's talk about this. The annual report just came out. And so what I want to do is kind of go through some of this, but this is big stuff, folks. They took a $3 billion write-down on its investments in Kraft and Heinz. That's Berkshire Hathaway. They took that $3 billion, that's billion with a B, write-down. And oh yeah, Kraft just recently reported a $14 billion loss and just disclosed that the SEC is now investigating them. So more to come on that in the future. So what's going on? Has the Oracle of Omaha lost his touch? Well, let's find out. Before you think the financial world is in near collapse, let's maybe hear the rest of the story. First off, a portion of Berkshire losses can be attributed to the new tax rulings. So these new tax rulings require public companies to account for some unrealized paper gains and losses. And if you recall, in the fourth quarter, it was kind of a bloodbath in the fourth quarter last year as we ended 2018. It wasn't pretty for anybody. And according to Berkshire and to Buffett, they said they had days where they experienced profits and losses of more than $4 billion in a single day. So that just gives you an idea of what that was like in the fourth quarter. Many of you that had stakes in the game, you know exactly how that feels. We all went through some of that here in the fourth quarter. And before you begin to shed a tear about how that looked, right, with Berkshire Hathaway, what that looked like, those losses, and I mean, those were major. We're talking billions of dollars. You should also know that Berkshire Hathaway's operating profits jumped in the fourth quarter by 72%. So to $5.7 billion, and operating profits alone for 2018 increased 71% to $24.8 billion. And revenue, well, that grew 3.3% to $247.8 billion in 2018. What? Still a good year by many standards. Look, I'm a Berkshire Hathaway shareholder, and I've been a Berkshire Hathaway shareholder for many years, and now I actually look forward to the annual reports. I watch them live on Yahoo Finance now, which is nice, and I enjoy two things about them. One, to learn to apply those uncommon, what Warren and Charlie call uncommon sense in life and investing. The second one is Warren's letter to shareholders. It's unlike any other letter to shareholders by any CEO anywhere in any corporation, because Warren's talking to you like you're a cousin, right? Or brother that's invested in him, and he's going to let you know in plain English what exactly happened to the money that you entrusted with him. And he does it again in plain English. It's unlike anything that I've read from any CEO of any company stock that I own. If you want to get a glimpse into what's in the Berkshire Hathaway annual report, I'm going to give you a glimpse into it. Here are 6 huge takeaways that I got, okay? And I hopefully it encourages you to go back to pull that report and to read it. It may make some difference. I think it'll make a difference. I absolutely love reading them. Number 1, Berkshire Hathaway will no longer feature the percent change per share book value in the initial paragraph of their annual report. And they've done this for 30 years. So why the change now? You know, iPhone, Apple made the same change. The market went in an uproar, the stock tanked. So here we go with Buffett. I shared with you some of those losses that they experienced. The Kraft Heinz deal, some of the impact of taxes, the implications of the tax change and how paper gains and losses are accounted for now. And so all those things. And now Berkshire is making a change. Well, they're just changing the way they used to report it in the first paragraph in the letter to shareholders. Warren used to open up with that. And Warren and Charlie say it's lost. They've done it because it's lost its relevance. And they give 3 circumstances why this makes sense for Berkshire Hathaway and for its shareholders. He says, and I'm going to read this, Berkshire has gradually over time morphed from a company whose assets are concentrated in marketable securities, that's stocks, and to one whose major value is operating businesses. As you know, they own a lot of businesses, and they're always keeping their eye out for more businesses. Those businesses have gradually become more and more profitable and a big part of the overall return of the portfolio. So in other words, they are buying more companies that are making up a greater part of their overall return, and it's the plan of Berkshire to continue to buy more companies. And number two, while Berkshire equity holdings, that's their stock, valued at market prices, accounting rules require Berkshire's collection of operating companies, that's the companies they own, to be included in book value at an amount far below the current value. So from an accounting standpoint, the way they treat that revenue and so forth from those operating companies really doesn't hit the mark, right? And so they've outgrown that. And so it's not a true reflection of where the company is. And number three, Berkshire will continue to be a significant repurchaser of its own stocks. And these purchases will take place at prices above book value, but below Berkshire's estimate of intrinsic value. And so understand this, in each repurchase transaction where Berkshire buys back its stock, its own shares, makes its per share intrinsic value go up while per share value goes down. The result is the book value scorecard becomes increasingly out of whack with the economic realities. And so there's, in the way how big this thing has gotten, and the way that they get the returns, it's just, there's no accounting method, the current accounting methods doesn't allow it to reflect. And so the company's worth way more in its operating companies than what's reflected in its stock price. So you can see where a percent change in book value up or down is, again, not reflective of what really goes on with Berkshire. Number two takeaway, buy and hold strategy of the right companies makes more sense, or should I say more dollars. Because of the way it's structured, so it has these equity, these marketable securities, it owns all these businesses, and its reception of dividends. If you understand dividends, and we'll have another video on dividends that you can take a look at. And those, just the dividends alone, represent $3.8 billion last year to the pockets of Berkshire Hathaway. So when you think about those dividends, $3.8 billion, so they've got all these equities, they've got all these operations, they're earning $3.8 billion in equities, and that's not even the best part. The other part, there's another part here that you gotta get this. And this is something that few people even understand or even think about. And that it is huge earnings that are annually retained by companies Berkshire Hathaway has equity stake in. So these companies, right, these increased earnings, as they appreciate, so does the shares of Berkshire Hathaway. But the way it's accounted for is a little tricky, right? So Berkshire Hathaway has an equity stake in these companies that are listed on their annual report. And the generally accepted accounting principles, GAAP, that's just the most commonly used or accepted ways of dealing with accounting information. Well, it doesn't allow, it says here, it doesn't allow Berkshire to include the retained earnings of investees. Now, investees, those are the businesses, those are the business entities like the Coca-Cola, the American Express, and so forth that they own. So Berkshire doesn't get to account for them in their financial account. So because of that, it gets very little attention. But let me see if I can help you get an understanding of this. So here's an example Warren provides in the Berkshire Hathaway annual report that will absolutely blow your mind and give you a better understanding of how Berkshire Hathaway captures these consistent high returns. Now, I already told you that they receive about $3.8 billion, at least last year they received $3.8 billion in dividends. So Warren gives this example of Berkshire's holdings of American Express, just to show you the impact of those earnings that the companies whose equities they hold, how they impact the purse book of Berkshire Hathaway and us as shareholders. Berkshire Hathaway has owned American Express for the last 8 years. But yet their ownership of American Express has increased. That means the number of stocks or the value of those stocks and how much of those stocks they own has increased from 12.6% to 17.9%. Now let me say that again. So their ownership of American Express stocks increased from 12.6 to 17.9. Now, how does that happen? So stick with me, and I'm going to try to explain this. Pay careful attention because you don't want to miss this. It happens as a result of American Express's repurchasing of its own stock. So, in effect, when American Express repurchases its own stock, it has some positive impact on Berkshire Hathaway. And let me explain. So when a company repurchases its own stock, what it does is it reduces the amount of stock available in the market, right? So the number of outstanding shares available in the market has shrunk. That means all the stock now, every piece of stock that's out there that the company hasn't bought back, all those stocks appreciate in value because there's less of them. So the value of them go up. You got it? Starting to make sense? And there is the extra kicker. The value of those shares increases even more when companies like American Express buy those stocks back, and they buy them when their stock is either at their intrinsic value or has fallen below the intrinsic value, right? So that's the real worth of the company as estimated. So when that happens, they make even more money. And then because of that, Berkshire Hathaway earns more money. But it's not accounted based on the way GAAP or GAAP is situated, is the way the policy is written. It doesn't get accounted for. So let me take this to its conclusion. Just last year, just so you get this, just last year, Berkshire's portion of the $6.9 billion earned by American Express was, guess what? $1.2 billion. So the $6.9 billion that American Express earned, $1.2 billion of that was earned by Berkshire Hathaway and its shareholders. Okay, that's the value of that. So realize Berkshire Hathaway, and this is interesting, Berkshire Hathaway paid about $1.3 billion for their entire interest in American Express. $1.3 billion. And of that $1.3 billion, guess what? Last year, I just told you this, right? Just with American Express, with their holdings of American Express, they earned $1.2 billion. So over an 8-year period, they spent about $1.3 billion buying American Express stock. So in earnings alone, Berkshire Hathaway earned 1.2, but they almost earned more last year in earnings than its total cost to buy American Express shares. Mind-blowing. So that might take some time to sink. You might have to rewind that and just kind of listen to that again, but that should give you some idea of just how good Berkshire Hathaway is, and Warren Buffett and Charlie Munger. So, and the third takeaway, Berkshire's insurance business makes up the majority of its earning power with a well-protected moat and a growing float. Now, a float is the fact that, when you pay for insurance, the insurance company collects now, but they pay you later. And then there's that gap, right, in between the time they collect from you and they actually have to pay out. So it's that gap, that's that float. And insurance companies use that float, and they can use that float and then invest. And so it gives them all this additional money that they have to invest. So, and of course, underwriting has to be done right and so forth. And because of the way that these companies like Geico and the other insurance companies they own underwrite, they're like the very best. And because of that, they don't put the business at risk. Here's another little thought. Geico, one of Berkshire's holdings, now has a policy in 13% of American households. Wow. Yeah, that's that little gecko thing, right? Running around. The talking gecko. So 13%, up from 3% when Berkshire Hathaway purchased Geico back in 1995. So they've gone from 3% of households having a policy to 13% since 1995. Also, National Indemnity, also owned by Berkshire, is the largest property casualty company in the world as measured by net worth. Unbelievable. Fourth takeaway, don't count on a dividend from Berkshire anytime soon. This question comes up every annual report. When are you going to pay dividends? And well, Warren's answer is we're not. So let's help you understand that. So what, and if you know what a dividend is, so when a company's net income is, after it's paid everything, it's sitting with a bucket of money, right? This net income they're sitting with. And they have a choice to do a couple of things. They can retain the earnings, right? Bring the company back in, reinvest those earnings back in the company. Number two, they could take a portion of that, share it with the shareholders in the form of dividends. They pay that out. Or they can do a combination of both. So that's an idea. So let me just take you through this a little bit more. So with $108.6 billion in cash and a proclivity to keeping $20 billion in a reserve fund or a rainy day fund in case the company needs it, means Berkshire is sitting on a whopping $88.6 billion in cash, stock buybacks, acquisitions, or dividends. That's a lot of money. So they like to have this big chunk of money because they're in a position right now. They've been looking for a company to buy because they really want to buy these good companies, right? And get them at a fair price. And then keep those companies and grow those companies like they've been doing with the existing portfolio. So Warren's preference is, well, his preference is to have stock buybacks rather than paying dividends, right? Assuming that Berkshire is able to buy back their stock at its intrinsic value or lower, right? Because it's all about getting a good value, both for the company and for the shareholders. So just as an example, this is why it makes sense that Berkshire not pay a dividend and why it benefits each of us as stockholders, because a lot of people get upset because, well, not all shareholders, but some, right? Because they figure it'd be a better thing for them if Berkshire would share more those wins with the shareholders in the form of dividends. Berkshire has $349 billion in equity capital. Again, unmatched in corporate America. And part of the story of that is how they got there, right? And it's by choosing not to pay dividends and instead retain all the earnings over those extended years. And so because of that, that's given them a real competitive advantage. So as a result, they've been able to allow the magic of compound interest to work, which has given them the capital base to buy so many wonderful companies and to buy deep on equities when they're at a fair price. So as an example, had Berkshire paid out a dividend over those years, the company would still be working with $22 billion it started with in 1995. So 1995, when they started with $22 billion. Well, if they'd paid dividends out, they wouldn't have the $349 billion that they have today to both protect the company and the shareholders and to really take advantage of the market. Number 5, Berkshire loves utilities and railroads. And you say, but why, Daryl? Why would they? I mean, do they really pay that much? Well, let's take a listen. Because when you're holding excess cash, you need some place to put it. And you need some place to put it better than low-yielding government debt. So Berkshire places that money in utilities and railroad businesses that provide Berkshire a nearly guaranteed rate of return, much higher than the low-yielding government debt. And number 6, the final highlight from the report for me is when Warren compares the investment with gold to equities over the last 77 years that he's been investing in equities. And he first started investing at 11 years old in 1942. And he explains it this way in the letter to shareholders contained in the annual report. He says this, now listen, he says, suppose in 1942 that you had foreseen this increase, and he's referring to the national deficit, which is skyrocketing. I think it's somewhere up to $22 trillion today. But let's say you have foreseen this happening in the future, and you panicked at the prospect of a runaway deficit and worthless currency. And to protect yourself financially, you might have eschewed stock, right? You might have just passed stock up completely and just foregone investing in stock and opted instead to buy 3¼ ounces of gold with your $114.75. Now, why does he use $114.75? Well, Warren uses that because in 1942, his first investment, that was the amount of his first investment, was $114.75. And that was invested 77 years ago. So that's why he's using that number. And you know, you hear, if you ever dial up on your radio to talk radio shows, there's always somebody going on about why to buy gold and protect yourself, buy gold, and gold is a way to go, and blah, blah, blah. And you hear buy gold coins, buy gold certificates, all these things, because they give all these end of world scenarios where there's hyperinflation and it will take a bar of gold just to buy a loaf of bread. I mean, so you hear, I know I hear these things all the time on the radio. Look, there were and there still are people today who believe that scenario, right? And so because of that, they've made some decisions today, yesterday, years ago, maybe even 7 years ago, to buy gold. Well, Warren asked this question, and this is what he said with this question. He says, what would that supposed protection in gold have delivered? So if you've had it 77 years, at $114.75, you invested in 3¼ ounces of gold, what would it be worth now? And this is what he said. You would now have an asset worth $4,200. Not bad, right? 3¼ ounces of gold, $114.75, bought back in 1942, now worth $4,200. But listen, this is less than 1% of what would have been realized from a simple, unmanaged investment in American business. Warren says that the magical metal, gold, was no match for the American metal, U.S. businesses. Now compare that to having invested $114.75 in a no-fee S&P 500 index fund. That's having all dividends reinvested. Warren staked that $114.75 would have grown to be worth pre-tax over $606,000 on January 19th, 2019. That is a gain of 5,288%. Let me say that again. A gain of 5,288%. Now you might have to rewind this just to make sure that you got this, that this sticks, of what he was able to do with that $114. Great annual meeting, great shareholder letter from Warren. And if you like this video, make sure you click the next 2 videos, how to invest your first $1,000 and how to double your money in the stock market. And remember, subscribe below, leave us a comment, and we'll see you on the next video.